The Federal Reserve raised interest rates by 75 basis points for the third time this year.
That's right, as expected. But Chairman Jerome Powell says he is determined to bring down inflation and acknowledged there are potential repercussions to this decision.
No one knows whether this process will lead to a recession, or if so, how significant that recession would be. The chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2%.
Lori Bettinger joins us now. She is the president of BancAlliance and the former director of the Troubled Asset Relief Program at the U.S. Treasury Department. Lori, I'm so glad to have you here. Errol and I think, are really interested in your perspective, given your experience running the Troubled Asset Relief Program, TARP. Yeah. What will this fifth rate hike mean for American consumers? Who are you most concerned about?
Thanks so much for having me. I think that it's going to affect all of us, all sort of different households across the country in a different way. First, you have to ask yourself, are you, a family or a person that is borrowing a lot of money right now, or are you saving? Let's start with the easy one, which is someone that saves. Let's say you have a bank account, your community bank. You're probably going to be paid a higher interest rate on those deposits. So you're going to earn more money. That's good for you. But if, like so many of us, you're someone who's borrowing money, you're going to have to start paying more. And you might see that first in your credit card statements. If you have a balance on your credit card, that rate that you're paying is very sensitive to this interest rate that the Federal Reserve is changing. It's worth taking a second to say the Federal Reserve does not control the rate you're paying on your credit card or your auto loan or your mortgage, but the rate that they're talking about really affects those. So credit cards are going to be affected. Auto, maybe a little less. Most people have fixed rate auto loans, so it's not going to change. But if you're in the market for a new car, which is probably more expensive thanks to inflation, you're going to be paying more. And then you can look at mortgages, which we're hearing so much about. The mortgage rates have really increased, year over year, month over month. And buying a house, exactly the same size house can be hundreds of dollars more expensive today than it was 6 months or a year ago.
Hey, Lori, I just want to follow up on the point that you were making, because it is an important one for everybody to understand that the Fed provides these numbers, but it's up to the individual banks to set those rates. Is it worth people trying to negotiate with their credit card company, for example, a lower interest rate?
That's a great question. And I would say the answer is yes. Whether you can negotiate with your current credit card or look around for different offers. Perhaps there might be credit cards that have introductory, zero interest rate offers. Or in some cases, some people look to take out different sort of debt consolidation loans so that maybe they have one loan that allows them to pay off higher interest rate credit card debt. I think this is a really good time to be an educated consumer, to make sure that you're managing this as best as possible and keeping your costs as low as you can in this rising interest rate environment.
Yeah, and it's also a good example of why it's a bad idea to carry a credit card balance from month to month anyway. Yeah. If it can be avoided, great financial advice. Spend money on what you have money to pay for right away. I want to ask you about how this is all impacted by the unemployment numbers. We had more than 200,000 Americans file for unemployment last week, which is up 5,000 from the week before, but still well below pre-pandemic levels. And the Fed is arguing that this strong labor market is one of the reasons it needs to get these interest rates up and cool things down. So what's your expectation of that? Do you see that strong connection? And if job growth starts to slow, what then?
I definitely see that connection. And we heard that, so much from Chair Powell's speech that, I think so many policymakers just think we have an overheated job market. We hear this number that there's almost 2 job openings for everyone who's looking for a job, which means that that increases pressure on people to pay more, which wages rise, which can be good for consumers, but bad for inflation. And, we keep seeing this very strong job market that's actually adding jobs. And then we talk about how many people are in the job market. It's called the labor participation rate. And that's been improving, but we're still not where we are before COVID. So there's fewer people out there looking for jobs. And I think what we've heard time and time again is that pressure in the labor market, where everyone keeps looking for employees and the resulting higher wages, continue to add to inflation. And it seems like the Federal Reserve doesn't see the inflation pressure slowing until the job market cools off slightly. And they've even said yesterday that, they expected to see a rise in unemployment as a result of their actions. And even when they talk about small percentage differences, that's over 1 million more people unemployed, which, is going to have a big impact on the country and, of course, those households.
It's so amazing to see the connection there between the employment market, getting full, wages going up, people have more money, spending more money on things, everything's now more expensive, and so you got to cool it down.
Quite a spider web.
Right.
Yeah, we appreciate you walking us through that web, Lori Bettinger. Thanks for connecting with us today.
Thank you.